Hello everyone, this is Paris. Welcome to Budgetholics. In today's video, we're going to talk about special purpose acquisition companies, or SPACs for short. The two mainstream ways a company can go public are either through an IPO or a direct listing. SPACs are a third way companies can go public, and they've been around since the 1990s. In this video, we're going to go over how SPACs work, the advantages of SPACs over IPOs, the history of SPACs, how to determine whether to invest or not in a SPAC, and lastly, what some proponents of SPACs have to say about them. If you're interested in personal finance, investing, and wealth building, please hit the like and subscribe button, as this helps me immensely with the YouTube algorithm. And if you've done so, let's jump into the video. I'll wait a bit. A management group called sponsors decide to form a SPAC, and they raise money through an IPO by selling units. Those units are typically priced at $10, and they include a share as well as a warrant. A warrant is a contract that allows the owner to buy a share of the company at a future date at a predetermined price, which is usually at a discount. After the IPO, investors can buy or sell shares at the current trading price. The money the sponsors gather through the IPO goes into a trust, and this trust is usually invested in either a money market account or short-term government securities such as bonds. After the IPO, sponsors have 18 to 24 months to buy a company. If they don't do so, investors are reimbursed for their money based on how many shares they own. However, if a company is found after being approved by the board, it merges with the SPAC and it forms a new publicly traded entity. This is also called the de-SPAC process. Shareholders can decide whether to stay invested in the venture or pull out their money. If they decide to stay in, their investment appreciates or depreciates as the share price of the new company rises or falls. Sponsors are paid by the success of the SPAC through share ownership called the premium. This premium allows sponsors to usually buy 20% of the outstanding shares in circulation at a discounted price. One of the advantages of a company going public through a SPAC is that it doesn't have to go through the regulatory barriers a traditional IPO would entail. This also means that if a company goes public through a SPAC, it usually does so in a much shorter time frame than the time it would take if it were to go public through an IPO. Moreover, there is less guesswork in determining at which price the shares should be offered. The sponsor's management expertise also helps in those steps. For investors, SPACs give them the ability to enter at a very early stage at an IPO. When it comes to traditional initial public offerings, you usually have to make an offer through an investment. With SPACs, you can get in earlier at a much lower cost to you. So this doesn't exclude smaller investors. Warrants allow investors to also buy more shares of the company at a later date, thus further enhancing their potential upside. As we said in the beginning of the video, SPACs have been around since the 1990s, and they've gained a bad reputation for defrauding investors. That's why in 2011, the SEC regulated them. And this regulation essentially allowed investors to be able to pull out their money before an acquisition was made. SPACs have experienced a huge rise in popularity over the last years. In 2013, there were 10 SPAC IPOs valued at $1.4 billion. While in 2020, 248 IPOs took place, valued at a total of $83.4 billion. So far, in 2021, 298 SPAC IPOs have taken place at a total value of $97.3 billion. Currently, there are 553 active SPACs, 120 of which have announced business combinations, while 433 are still seeking target companies. Additionally, there are another 257 SPACs at the pre-IPO stage. Some well-known companies that went public through SPACs are Virgin Galactic, ticker symbol SPCE, DraftKings, ticker symbol DKNG, and Nikola Motors, ticker symbol NKLA. At this point, I should point out I'm not a financial advisor, and this video is for entertainment purposes only. This video is not meant to convince you to buy SPACs or offer any investment advice whatsoever. For transparency reasons, I haven't invested in any SPAC, although I have invested in Virgin Galactic and DKNG, which were two SPAC offered companies. That being said, how do you determine whether to invest in a SPAC or not? According to a TD Ameritrade video, for which I'll leave a link down in the description, there are 4 things to consider. Firstly, a SPAC is a shell company. That's why they're also referred to as a blank check company. SPACs do not have any product whatsoever for you to evaluate. So you need to be absolutely sure that the management team of sponsors know what they're doing. The second thing to take into account is that you should carefully read the SPAC's IPO prospectus, as well as current and periodic reports filed with the SEC. As an investor, you should always know what you're getting into, and reading those documents will help you paint a more accurate picture of what the SPAC is doing and whether this is a good investment or not. Thirdly, if the SPAC reaches the stage where a target company is identified, you need to also evaluate whether this company is a good buy or not. After all, you're only owning the SPAC temporarily, and your end investment will be in that company. The fourth thing to consider when determining whether to invest in a SPAC or not is the opportunity cost. Why would you invest in a SPAC instead of investing in an established company? A study following 97 SPACs from 2011 to 2017 found that in average they underperformed the S&P 500 by 3%. And another study between 2015 and 2019 found that the majority of SPACs were trading below the $10 per share mark. SPACs are not free of risk. Let's hear it from Chamat Palihapitiya, and I'm sorry if I murdered his last name, from his interview on the Unchained podcast.
I wanted to dive a little bit more into your view on ICOs, because you have been trying to kind of reinvent the IPO, or at least just address some existing problems with the IPO process through this through Social Capital Hedosofia Holdings Corp. And you can correct me if I said that incorrectly, which basically executes SPACs, which are special purpose acquisition companies. So why do you think that's the better way to IPO? And yet, ICOs, which also kind of similarly offer easy liquidity, obviously you didn't think that was the way to go. So, do you see any way in which blockchain technology can be used? Or is it just, again, like you said, like the technology doesn't matter and SPACs maybe just solve the problems that you see?
The technology doesn't matter. The outcome matters. In this case, what the outcome is that matters is the following. There were 8,000 or 9,000 public companies in 2000. There are about 4,000 now. 2/3 of the S&P 500 have no R&D budgets. Now, you can say, well, this is a stock market problem, but I actually think that this is a US economic problem, which is that we don't have capital markets that can support young, high-growing, fast companies in a way that really builds for the future of America, the resiliency of America. And so we need thousands of companies to go public. And so we need to frame the capital markets in a way that they understand why they should be buying future growth and product iteration and R&D versus current cash flow. It's this obsession with current cash flow that has driven the private equity boom, that has driven the debt boom, that has driven 8,000 companies to shrink to 4,000, and that has driven a lot of unnecessarily volatility in the public equity markets. So by building this platform, this IPO 2.0 platform, what I would really like to do with my partners is sort of pioneer a way for young, high-growth companies who can invest lots of money over the next 5 to 10 years to go public. And the way that I do it is we pre-wire the IPO. We go and we curate investors. We explain what we're trying to do. We explain the dynamics of the market. Then we go and find a target company. And then we break the business model down for these folks. We price it in a way that's fair. And we eliminate a lot of the overhang in the stock, like things like lockups and whatnot. So there's benefits to the CEO and founder, which is that they get better understood in the public markets. So then there's more long-term support. They get to go public in 90 days versus 18 months. And it's just a much lighter weight process. And then for the public markets, what's really important is and I'm using sort of, my accumulated quote unquote social capital and credibility to say, let me explain to you why you want to own this thing for 5 to 10 years. And look, I can only do this one company at a time. Although in this current case, the first one was Virgin Galactic. It's been a real success. I raised 2 more SPACs, and so we'll see what happens. I'd like to raise, some more after that. But by doing this incrementally, I think that I'll help educate the smartest hedge funds and mutual funds to want more of these younger businesses. And then younger businesses will be less afraid of going public sooner. And that'll start to turn the capital markets momentum in favor of long-term growth. And that has huge ramifications because then hedge funds will tell companies, invest more in R&D, and that actually has huge implications for the US economy. So to me, it's all about that.
Chamath's company, Social Capital, allowed sponsors to buy shares at a price of less than 1 cent per share, whereas investors could buy in at $10 per share. So there is a clear disparity of payouts between shareholders and sponsors. And through Clover Health, one of the recent Chamath SPACs, we can say that SPACs are not without risk. For example, in the case of Clover Health, the Hindenburg research team discovered that Chamath's pitch might be misleading investors. Although a verdict has not been reached by the authorities, just the publication of this report caused the shares of Clover to drop from $16 per share all the way down to $7 per share, which is a 55% decrease in share price. The second proponent is Bill Ackman. Let's hear it from him in a CNBC interview.
What we've done is we've taken what I think is a good idea. The idea of raising a cash shell to really bypass the going public process, which is a risky, time-consuming process, I think is a good idea. The problem has been the terms for investors, really, as you described. And what's new in our structure is it's the first SPAC where we're taking no compensation. There are no management fees, incentive fees, promotes. We're not buying cheap stock. There's literally no compensation to the sponsor. The sponsor in this case is not us personally either. It's the Pershing Square funds. So we've set this up to create an investment opportunity for the Pershing Square funds. And our investors, of which the employees of Pershing are the largest, we own about 23% of the Pershing Square funds, are indirectly investing. And we set up an alignment that was very appealing to investors. So we created the most investor-friendly SPAC in the world, and we had an enormous reception that gave us the ability to do very large scale. We now have a $5 billion equity check, if you will, that is going to be trading in an hour or so on the New York Stock Exchange, has the ability to issue securities. And our goal is to buy a minority interest in a business. And what I mean by that is we're going to merge with someone, we're going to take them public, our shareholders will own 20%, 25%, 30% of the company. We believe we can make an advantage deal for our shareholders, while really creating a great opportunity for a company to accelerate its growth, deleverage balance sheet, maybe provide capital for investors seeking to an exit. So we think it's a great structure, and we've had a wonderful reception by the investors.
This was a short overview of SPACs. I'd love to hear your thoughts and whether you would invest or not in a SPAC. If you enjoyed this video, please hit the like and subscribe button, as this helps me immensely with the YouTube algorithm. Also, share this video with anyone you think might find it useful. Until we meet again, don't stop investing. Cheers.